Hello, everybody. This is Hyun Park coming to you from Amalgam Insights, and today we are talking about managing IT finance. This is a really interesting topic for me because I think this is where people get to start talking about the strategy of IT cost, which I'm going to start digging into across the throughout this webinar. But first of all, I think there's this real confusion about what IT finance is. I think everybody who touches IT costs to some extent says that they are doing IT finance, and that's a real mistake. Not only because it's confusing from a perhaps technical perspective or from an academic perspective, but because finance is where costs start becoming strategic, and where you're able to start talking about the aspects of the money of IT in a way that is strategic to the organization and that allows you to have strong cross-departmental discussions. This is where your career starts getting more strategic, where you start being able to talk at a higher level, where you start thinking about executive concerns to a greater extent, but you can't get there if you don't talk about IT finance as an actual financial topic rather than simply as an accounting topic, an expense topic, a procurement topic. All those are important as well, but don't get to talking about finance. So before I get into that, as part of the reason I'm talking about IT finance today is that this is a preview webinar for the virtual event that Amalgam Insights is holding on July 14th, TEM Expo, the future of managing tech expenses. Our goal here is to cut costs and save jobs. And we have the goal of this event and the webinars that we're holding around this is to help our attendees collectively save $1 billion in 2020. This is our stated goal. We realize that timely cost cutting and cash savings are important at a time when we are all trying to help our businesses run, and this is what we can do in our roles across IT, operations, finance, accounting, procurement, where we are responsible for dealing with the actual cost structure and then financial outcomes associated with IT. So this virtual event is going to include networking, educational opportunities, charity, as well as, of course, the mandatory swag that will be sent to all attendees. So please feel free to sign up. The landing site is Amalgam Insights /TEM Expo, which we'll share with all attendees after the webinar. And thank you to our foundation sponsor, MobiCord, who has generously agreed to sponsor both the event as well as the webinar as they make this content possible. So thank you so much for them today. And we're looking forward to hearing from them later at the virtual event itself. So, why are we doing this? There's this massive labor shift that's happening in the United States right now, where you can see just from the end of 2019 that blue bar at the top represents who was working from home full-time at the end of 2019, about 8% of Americans. And today, that number is closer to 42%. And then on the right side, you can see on yellow, our unemployment rate was basically at about 4% at the end of 2019. Now we are hovering around 24, 25%. Hopefully it doesn't get worse, but that's an extreme number right now. We've cut a lot of jobs, and companies are doing so partially because they're not sure about their cash position or their financial position across the rest of 2020, and they are trying to be conservative and keep their companies open. That said, we have an opportunity in IT to be able to cut some of these costs and to be able to improve our cash positions based on what I call the IT rule of 30. And the IT rule of 30 basically says that every unmanaged IT spend category averages about 30% in waste over time because they haven't been overseen, they haven't been audited, they gain waste and slack over time just as people come and go. And this is especially a problem in times of great flux, either when companies grow or shrink quickly, either due to M&A or layoffs. Obviously, this has been a big issue over the past couple of months as everybody's been reconsidering their cost structure. So as people have been furloughed or laid off, or as IT commitments and technology commitments to specific employees or projects have changed, there's been this waste basically created, these unassigned projects, unassigned technologies that now need to be cleaned up. And when you look at the bottom row here, basically, if the IT Rule 30 was cleaned up across organizations, you would be able to save 1% in bookings. This is assuming that you have an IT organization that is relatively unmanaged and dealing with costs and expenses on a manual basis that is distributed because you haven't treated IT costs as a serious issue previously. You know, there's about 1% of bookings in waste, which probably equals about 5 to 6% of your payroll, probably about 15% of your operating margin, your profit. And of course, there's a lot of differences in these metrics based on your verticals. You know, low profit versus high profit verticals have very different experiences here. But you know, the numbers can be quite significant in terms of your bottom line results. But how do we start getting there? You know, first of all, we've talked about this, the 6 stages of managing COVID IT in the past. This was the subject of the first webinar that we did. If you haven't seen that one yet, please feel free to go back to that one after this webinar. But you know, that we have 6 stages of managing COVID IT. Stage 1, which we were dealing with in March and April, was basically just about survival. End users did whatever they had to make work happen, and they didn't necessarily follow the rules because it was there were more important issues at stake, quite frankly, about simply keeping the company alive. But now we are at stages 2 and 3 around securing the business, auditing the business, and making sure that everything is cleaned up so that we can make good decisions going forward. So as we're making these good decisions, it's important to start thinking about this from a finance perspective. And today's goal is to talk about what IT finance actually means. Now, I don't have time to go through an entire Introductory Finance 101 course. Obviously, this is a standard college or MBA course that you can go through. But what I can do is point out some of the aspects of finance that are different from pure expense management, cost management, sourcing, etc. So thinking about that, you know, when I think about IT finance, first of all, I think of it not simply from a kind of technical definition, or but really how it's a fundamentally about a shared vision of corporate health. This is where IT and finance have come together and agreed this is what the company looks like when the company is healthy and using technology correctly, both to empower employees and give employees what they really need from a practical perspective, as well as from a financial perspective, what it means to be good stewards, to be responsible, and to use money correctly to support employees. This does not mean simply cutting to the bone, because if you cut to the bone, you will cripple your ability to work as a company, which is a bigger problem. If you cut IT costs to get to that 1% of bookings, but in the process you eliminate 10% of your business effectively by ruining productivity, you have really done yourself a disservice. So there's this holistic idea of this shared vision of corporate health that IT, finance, and other related stakeholders need to understand from an IT perspective and from a finance perspective. That said, when we think about finance, finance is not just cost management. It's not just about processing the bills, and it's not even just about cost optimization. And this is a mistake that I see over and over again. Companies thinking that because they are able to look at the bills that they have in place and they have an idea of how much they are spending, and even that they are optimizing bills and optimizing their IT portfolio, that they are doing IT finance. No, that if you're dealing with bills and you are cutting costs simply based on the amounts that you're getting. That's cost management or expense management, which is an important piece of the puzzle, but not the entire piece of the puzzle. Finance also includes areas such as income, cash management, business outcomes, budgeting, and forecasting. And I'll talk about each of these areas later as well, but these areas all go beyond simple cost management, because income, you're dealing with your actual profitability of the company. Cash management, you're dealing with cash flows on a month-to-month basis, not simply did we save money, but are we actually getting that money back now, and are we able to reallocate that money to other use cases or other parts of the corporate budget. Business outcomes, this is where we're talking about a return on investment and actual payback period, actually getting to the point where you can justify IT investments as more than simply a want to have or need to have or everybody likes it qualitative perspective. And then budgeting and forecasting speak to understanding how IT costs are going to be measured going forward and how they relate to the demand side of what is happening within your organization. So as we think about IT finance, first we have to be able to actually break down the costs effectively, which means not just optimizing the costs, but understanding how IT is being used from a user perspective. Who is using each asset or service? The owner perspective. Who is responsible for each service, and how is that updated as each owner moves to different departments or leaves the company, or as new people come into the company to take over specific projects or resources. Now looking at cost center, profit center, department, location, as well as relevant projects associated with each asset or service. Ideally, you should have this information in place, because this is necessary to understand how each cost ends up rolling into the financial aspects of your company. Next, looking at key metrics to understand. First one, key one, I think, is understanding from your organization's perspective what your IT budget is as a percentage of revenue. Out of the money, all the sales, all of your receipts that come into your company, how much of that money ends up being used for IT? Because from an industry analyst perspective, I can tell you all day long that for core IT, typically it's around 3% of revenue. If you include all the experimental technologies that get used for sales and marketing and all the shadow IT, it's closer to about 5%. But that doesn't really mean anything without context as to what kind of company you're actually running, because it could just as easily be 1% or 10%, depending on what vertical your company is. But you need to understand how much of your IT is as a percentage of revenue. Next level of understanding that you need is the second row around your operating margin and your payroll as a percentage of revenue. So what is your actual profitability? If you are making, let's just call it $1 billion. Does your company at the end of the day actually make $10 million off of this, or $100 million? Whether you have a 1% margin or a 10% margin makes a huge difference in what you need to do next from an operating perspective. And the payroll as a percentage of revenue. This is important from a very tactical perspective, because as I said before, IT Rule of 30 means that we typically have a chance to affect up to 5 to 6% of our payroll. And being able to understand and being able to articulate to your financial stakeholders that much is at stake by managing IT finance correctly really provides an opportunity to be able to clean things up that may not be readily obvious to our controller and CFO team counterparts. And then at the bottom, I think some of the key metrics that you need to start thinking about from a finance perspective are around return on investment, cost of capital, how much it really costs you to use money from an IT or from a business perspective in general, based on what your business is expecting to do. Net present value and internal rate of return are financial metrics that your actual finance users are going to be using to identify opportunities and to across the board. And if you're not providing NPV and IRR as metrics associated with your IT investments, you're already a step behind everybody else who is treating their expenses and their financial outputs as in terms that finance understands. NPV and IRR don't necessarily mean everything in the world, but they are a way for the CFO to put everything on the table at once and say that's the highest number, comparing across opportunities for IT, operations, HR, supply chain, the sales, marketing, the rest of your company. So it's important to be able to at least be able to figure out how to have that number in place. You probably have somebody in your department or in your related organization who has experience with these metrics. Just an idea there of where you need to go to talk about this IT from a finance perspective. And then on the bottom right corner, jobs saved. You can see, that's really the goal right now in 2020. I think anybody who is not thinking specifically around cash management and jobs saved is really missing the boat. And it's possible to really get past that at a time when our unemployment is near 25% in the United States. So, just a note on return on investment, that return on investment is a term that often gets misused. People use it just as simply as a vague buzzword, but it does have an actual meaning that ROI or return on investment is specifically about the net return that you get based on your investment. And it's always a percentage number. If somebody mentions ROI, does not mention a percentage immediately afterwards, they're not really talking about financial return on investment in a way that is meaningful to the finance office. It does have to be higher than the cost of capital. So in this case, that means your ROI for a project always needs to be higher than basically your profit, what you would expect to make if you put that money back into the business in some other way. If you can't talk about how your ROI is better than your profit margin, then that's a non-starter from a financial perspective for being able to okay IT spent. That said, there are ways to goof around with ROI as well, so you have to be careful with that. If you extend ROI to over 1, 2, 3, 5-year period, it starts becoming a little bit more sketchy because it's so hard to look into the future. Because of that, it's a lot easier in 2020 especially to look at on the right at payback period. Payback period is the term that you use when you're talking about the time needed to get your money back. If you put $10,000 into an investment and you get $10,000 back within that 6 months, 6 months is your payback period. And right now, everybody is looking for rapid payback. If you're not getting payback within, I would say 3 to 6 months right now, you are, it's much harder to work with your project. And I would say, in that regard, think deeply about that, because that affects your cash position at the end of the day, and that's what finance is thinking about right now. So some statements that you should be comfortable with for contextualizing IT are the income statement, the balance statement, and the statement of cash flows. And these are 3 different statements that finance uses to contextualize money. And so these are basically what you might think if you don't have a finance background. Income statement is basically just about defining the income that your company has. Balance sheet talks about your assets and liabilities. And then the statement of cash flows shows the cash that is coming in and out. And these are 3 different things. If you don't know the difference between these 3, you're not talking finance yet. You're still at the expense level. So just as a very quick starting point, let's talk about what each of these 3 end up meaning very tactically right now. So income statement, it talks about basically your profit. And strangely enough, realize that income and profit is not the key financial metric right now, which sounds counterintuitive if you're coming to this from a common sense perspective. But your profit doesn't necessarily dictate how much cash you have on hand right now. Obviously, profit's very important for all sorts of other things, the valuation of your company, your stock price, all these other aspects of business health. But right now, May of 2020, June of 2020, July of 2020, as we are dealing with COVID and quarantines and trying to get people back to work, profit's not actually the key financial metric right now. It's much more important to think about cash. So as you think about the income aspect, you want to be able to thinking about this bottom row, understand the difference between gross income and net income. Gross income being based just on the cost of goods sold, net income including costs such as sales and administration and research and development and other areas, and net income really reflecting the amount of money that you're making. But also understanding that your net income isn't necessarily the goal here. The goal is to have cash on hand. Just because you look at the income and statements and say, well, if we do this thing from an IT perspective, we'll improve our income, that might not necessarily be the key financial problem that your company is trying to solve in the here and now. Second of all, thinking about the balance sheet, assets and liabilities. This is where CapEx versus OpEx starts mattering. You need to be able to describe what you're doing from an IT perspective in terms of what are assets, what are liabilities, and how your spend actually plays into each of those areas. This is where you can at least get help if you're not experienced in CapEx versus OpEx, capital expenditures versus operational expenditures. One of the keys here is that companies often think about their return on assets. If you are providing assets to your company, you need to work with that metric as well. It helps make your financial argument. It is a step beyond return on investment and may position what you're trying to do from an IT perspective differently. Again, working with your finance contacts within your organization to determine what your key benchmarks and key hurdles are for determining the return on assets and being able to justify investment is important in this regard. Just thinking about what is an asset, what is a service, and how each of those are treated differently from an investment perspective is important internally within your company as you're thinking about IT finance. Then next, statement of cash flows. This is what determines, what shows how much cash is actually coming in and out of your company. And this is what is most important right now. Companies are trying to figure out how to actually have enough money on hand. And this number can be quite different from either your income or your revenues, because there's a lot of ways to deal with cash flow. As we know on the IT expense side, if you simply pay a bill late, you keep that cash in the short term. And there are tactics like that you can use to at least artificially maintain cash in the short term if it's really important. But obviously, simply postponing cash payments is not a great idea without some sort of bigger plan. So this is where talking to IT finance around specifically cash flows and how companies are and how your company is thinking about this and where your company needs to improve cash flow management or cash management specifically in this quarter and the next quarter is really important if we're talking about finance. If you're simply going to IT finance and bringing up all these things about profit and cost optimization and how moving CapEx to OpEx without really understanding how this affects your cash flow and how this affects this on a day-to-day or month-to-month perspective, you're not in the same room, and you may have your suggestions and opportunities to improve IT spend ignored simply because you're not speaking the right language to be able to get through to the finance office compared to your cross-departmental counterparts who are bringing up projects and opportunities in the language that finance understands. So given all of that, here are the takeaways that I'm providing as for thinking about IT finance in 2020. First of all, think about that IT rule of 30, a 30% opportunity to reduce costs in unmanaged areas. This is especially important for cloud infrastructure as a service and software as a service, which are probably the only two IT areas that are going to be growing across the rest of 2020. Everything else is projected to shrink by 5% or more if we're talking about traditional telecom, data center, et cetera, servers, et cetera, et cetera, et cetera. Second of all, finance is more than cost management. Finance is about thinking about your financial planning, about your income, about your cash flows, understanding really the breadth of how money is used within your organization. And it's important for you to be able to speak that language of finance, or at least have a common lingua franca, a common language to share with your financial stakeholders that goes beyond simply talking about basic cost management and basic bill management. Third of all, work on a shared vision for corporate health. This is the time to figure out what does it actually mean to cut costs, responsibility, and work towards that aspirational goal I brought up at the beginning of the webinar of cut costs, save jobs. How do we get there? We as IT cost and finance professionals want to contribute, but how does finance think about this? How reactive or proactive is the company being? What are the opportunities there? Until you have that conversation about what is that shared vision for corporate health, and it needs to happen now, obviously, because you need to take action based on that vision. But if everybody's acting reactively and simply trying to, quote, do their best to cut costs without agreeing to what it means from each of these areas that finance really cares about, you're flying blind and you may be doing the wrong thing for the right reasons. So it's important to have that shared vision for corporate health. Fourth, defining ownership for all assets and services. This is absolutely key right now. This is a cleaning up exercise to some extent, as a lot of IT assets and services have come in through shadow IT or through non-traditional sourcing means, which is fine. We have to accept that happened. Pretending that didn't happen in March and April is simply suicide in terms of being able to actually get things cleaned up. First, you have to accept that happened, and then start working on cleaning things up based on the cross-charging opportunities and categories that I spoke of earlier. Fifth, understand how IT costs affect key statements. So again, the income statement, the balance sheet of assets and liabilities, as well as statement of cash flows. You have to understand how your costs affect each of those areas differently, because that is, if you're talking to finance and wanting to talk about being a true IT financial professional rather than an IT expense manager. It makes a big difference in the discussions that you're going to have with both line of business and finance managers, and this affects the ability for you to understand what impact you're providing on the company. What I tend to find is that people who just talk about cost and expense actually reduce the understanding of their impact on the business, partially because the expense pros don't understand how much of an impact they're really making, and then the executives at the top aren't hearing the story from anybody else. In this case, if you don't toot your own horn and you don't provide a context for how what you're doing matters to the company's big picture understanding of margin, profit, return on investment, return on assets, nobody else is going to be able to figure that for you, and people won't be able to help you do a better job at the end of the day. And then finally, on the bottom right, providing relevant metrics to justify IT investment. Right now, it has to be about cash management, saving jobs, taking care of the core business. Anything beyond that is nice. If you're one of the few companies that is growing like gangbusters, obviously you get to keep thinking from a growth mindset. But for most companies, it is important to think more about immediate payback period in cash rather than perhaps some ROI that might be 2 or 3 years in the making, or some sort of a cash manipulation that may not make an impact in 2020. Think about what actually matters in 2020 from the finance office perspective as you are talking about IT finance and IT costs. And with that, thank you so much for your time today. I would love to talk about this further with you. I realize we went through a lot of topics really quickly, but it's really important to understand that IT finance is so much more than simply dealing with the bills. And although we have a lot of the information in our hands to start with when we're doing our cross-charging and when we're identifying cost-saving opportunities, there's a few extra terms and a few extra opportunities that we have that really talk to the finance office that increase our strategic positioning. So with that, we're going to be talking a lot more about this at the virtual event we have on July 14th. Please contact us at temexpo@amalgaminsights.com or sign up at amalgaminsights/TEM Expo for your free ticket to this event. And if you have any questions about this, please feel free to contact us directly as well. Email us, call us, engage with us on Twitter, whatever makes sense to you. With that, thank you so much for your time today, and I look forward to speaking with you in the future. Take care.